It can be really overwhelming and really scary, the thought of losing money on any asset that you own, whether that's property, whether that's a business, whether that's crypto, whether that's stocks or shares or commodities. Now, I'm going to talk about what you can do in a declining property market to take advantage of those conditions and how to get yourself through the next year, couple of years, or at any stage in the future that a decline is either coming in preparation or if we're in one, so that you can create a plan, logically think your way through it and end up in a significantly better position after it's all said and done. G'day there, my name's Ben Everingham and today's video is what to do in a declining property market. Now, this is based on my experience of investing over the last 10 years, reading books on the American, Australian, and European stock and share markets, as well as property markets, literally over the last 200 and 300 years. So we're going to talk about how you can take advantage of current conditions and what to do at this stage of the cycle. Now, the very first thing to do in a declining property marketplace is to be careful. Now, this sounds logical, but there's a lot of people that don't run on logic. I've found talking to over 6,000 investors now over the last 10 years, most of them actually run completely on emotion. There's only about 10% of personality types that can always be on the logical side of things. Now, when I say be logical or be careful, we're really talking about being strategic and being patient. Now, if you already own assets and you bought them at the wrong time, think buying something in Sydney in 2017, think buying something in Melbourne in 2018, think potentially buying American stocks at the moment, you've got to be patient. Now, if you're a long-term investor like I am, what happens in a year or a couple of years has no impact on where you'll be in 10, 15, 20, 30, 40 years from now. And that is one way that you can think your way around this. But if you have an asset that is declining in value in the short term, a lot of investors panic. Now, a great example of this is when cryptocurrency got up to $26,000 in 2018. It's now in 2019 sitting at what, $3,500. A lot of people panicked. A lot of people got out of the market. Now, smart people never bought crypto for last year probably anything more than $5,000 because they bought in early and rode the wave and hopefully sold at the top. But unfortunately, a lot of people buy high and then sell on the way down as well. So it means they're losing huge amounts of money and copping a nice big right hand on the chin. So I don't want you to be doing that. If you have an asset that you plan to hold for the long term, don't worry what the media is saying. Don't worry about what other people around you are saying. Don't get caught up with the fear. As long as you can afford to service it and hold it, that asset's value in 10, 15, 20 years from now is going to be exponentially higher than you can imagine right now. Short-term fluctuations are part of a cycle, and that is why there is a downward side, a bottom side, an upward side, and a top. And that happens in property, it happens in other markets as well. So I wouldn't be rushing into the marketplace right now in Australia, particularly in Sydney and Melbourne, that have been very, very expensive now for quite a few years' time, where all of that easy money that we got from the banks and from the government after the GFC went flooding into those markets, as well as all of the international money. But there are other marketplaces in Australia that represent really good buying because they haven't been through that ridiculous 80, 100% growth cycle like those other markets have, and therefore they're not going to decline as hard, or they might not decline at all. The second thing that you can do in a declining property market is to create a plan. Now, there's two types of plans. There is a 12-month plan. I don't know why I just gave you a 2. And there is a longer term plan, which for me is sort of a 15 to 20 year plan. Now, I always know where I'm starting from. So at the start of every year, I have a loose idea of where I want to be by the end of it. Obviously, I don't let that plan shape my entire reality. Things change, markets change, opportunities come up, opportunities are taken away from you. But if you have a plan, then you're in a much better position to take advantage of a down market. And if you've got a long-term plan and a long-term approach to things, then when assets are down or the prices are down or sentiment's low or there's less people in the market that you have to compete against to buy the asset at a reasonable price, then you can enter that marketplace, buy at a good price, 10, 15, 20% below what you could have a few years ago, and then hold it for the long term and end up in a much, much better position before everything turns back to business as usual. I think another important thing, the third thing, is to review and improve your position. Now, if you're one of those people that sort of gets stuck in the mud each time life gets hard, or you run away from things, that's completely cool. If you're like everyone, either fights or flights at different stages. There'll be a lot of people flighting the market, particularly the stock market, I believe, in the next couple of years. There'll also be some people flighting the property market, which represents a great opportunity. You've got to have the stomach to be able to stand there and go, I have a plan, I'm going to see how things go, and I'm going to work my plan so that 15, 20 years from today, my life looks the way that I want it to look, and I've got the choices that I want to make. So in terms of reviewing your position, I really want you to look at your savings position, your cash position, your equity position, and your budget, and go, where am I realistically right now? What is my total asset value? What cash do I have on hand? Is that enough to safely get me through a period if I lose my job, or I need to kick in a bit because I lose my tenant? I also want you to review your budget, which I've just done with my wife, and we were able to save literally 35 to 40% of the fixed costs in our life just by renegotiating cheaper phone plans, cheaper electricity plans, cheaper internet, getting solar on the roof so we don't pay for electricity anymore, getting the water tank that was in the backyard when we moved in working so that we don't have to pay for the water, like doing all those little smart things, getting rid of car loans, getting rid of any credit card debt, just putting yourself in a position where you understand where your break even is now, and then you strategically review each of those little areas of your life one by one, maybe over the next 12 months, and systematically reduce the costs in your life. Now, the reason it's important to reduce the costs is if the worst case scenario happens, then you don't have these ridiculously high amounts of money going out of your account each week that are fixed that you can't reduce. The main reason I did it was because I wanted, for the last couple of years, I've been stacking cash as much as I can so that I can take advantage of conditions as they come up. Because if stocks do come on sale at 20, 30, 40, 50% below what they're worth right now, and we're only halfway through the 18-year real estate cycle, which means at the top of the cycle, think 2005 type thing, last time round, I know those stocks today are fucking cheap compared to what they're going to be worth at the time 7, 8 years from now, but I also don't want to pay full market value for them today. I'll wait for them to come on sale and hopefully get them for a steal. So there's heaps of different ways that you can invest. This is just my little ideas for me personally. Just review your position, improve your position. Now, the fourth thing is kind of the same, which is reduce your costs and keep a buffer in place. It's always the people that don't have a buffer, that have high costs coming out of their life that they can't control, that get caught selling assets in a bad marketplace where they're selling them for a discount. But if you are in a position where you have a buffer and you can stomach the fact that you might lose a bit of money before you make some more over the next 20 years, then you just smooth through that period of your life. You focus on buying the distressed assets at the right prices and setting yourself and your family up for the next stage of the cycle and for your future. The fifth thing is to take advantage of sentiment. As Warren Buffett and Ray Dalio, the two most successful investors of our generation, say, buy when others are greedy, buy when others are fearful, sell when others are greedy. Or as Ray not so elegantly puts it, that was Warren's way of saying it, Ray Dalio says, buy when there's blood in the streets. Now, I read this awesome little quote which I put into notes a while ago. I just wanted to share it with you. It is, the market is a pendulum that swings forever between unsustainable optimism and unjustified pessimism. The intelligent investor is an unemotional realist who sells to those optimists at the top and buys from those pessimists at the bottom. What a fucking awesome quote. The market is a pendulum that forever swings between unsustainable optimism and unjustified pessimism. The intelligent investor is an unemotional realist who sells to optimists and buys from pessimists. I fucking love this stuff. You know, take advantage of sentiment. Don't buy like silly people did in 2017. I was saying in 2015 on these videos exactly what was going to happen. If you follow Phil Anderson's work, Fred Harrison's work, Ray's work, Warren's work, you can start to see the way that things move. If you follow the CoreLogic updates, the Heron Todd White updates, you'll have a massive advantage over other people in the market. Now, I'm not saying rush out there and buy stuff. The very first thing I said was be careful, create a plan, and do nothing if you don't understand this stuff. But if you do understand that, you know, it's going to be hard when everybody else is running away from it, because as humans, we're social beings and we run towards what everyone else is doing. Which is why people buy assets at ridiculously high prices when they could get them at a good discount a few years later. But take advantage of these conditions. Sentiment doesn't always look like this. The media is not always going to be bashing property for the next 50 years. People aren't going to think these prices are expensive in Australia in 30 years' time. Interest rates aren't going to be this low. It's not going to be this easy to get money. Always, there's not going to be so many people sitting on their hands forever. I'm not saying go out there and buy something, but I'm just saying think about it, create a plan, educate yourself. Remember that not all of Australia is one market. Sydney and Melbourne are cooked, and I believe that they won't be good buying again. Personally, for me, I won't be entering those markets until after the next GFC again. But Southeast Queensland looks really interesting to me over the next stage of the cycle. And look at CoreLogic's analysis of this history. Look at John Lindemann's. Look at some of the smart Australian analysts out there. Now, the sixth thing is simple: buy for the long term. I really don't care what happens over the next couple of years, because I'm looking at averages over 12 years. There's times when Apple stocks are worth 50 cents in the dollar. There's times when Apple stocks are completely overpriced and worth 150% of what they should be. I just choose to buy when the stocks are at good prices, or I like to buy when they're at reasonable prices, as opposed to, you know, playing the game that everyone else plays and buying when everything feels great. So buy for the long term. It makes you feel a lot better. It makes you sleep a lot better. If you've got a plan, you're buying for the long term, you're taking a low risk approach, and you've got a good savings buffer. You know, the media is just the wind blowing. I choose to set my own sails and the direction that I'm heading, and I'll take advantage of good and bad conditions as they come up. Now, the last thing I wanted to talk about is with any asset you're buying, as Warren Buffett talks about in his new documentary, the HBO one, which is free on YouTube. He talks about value investing and buying for the long term and buying assets at reasonable prices with great potential for the future. So I love that concept. I personally prioritize long-term capital growth and medium-term, short-term and long-term cash flow above everything else when I'm investing personally. Everybody's got their own opinion, but these are the things that I've learned from buying over $300 million worth of property now for myself and for my clients. I don't have a crystal ball. I don't know what the fuck's going to happen, being honest with you, but I just follow a lot of smart people and a lot of analysts and try and work my through market conditions, good or bad as they present themselves. So a down marketplace as a bearish investor, which I am, is a dream, but it's not everybody's cup of tea. A lot of people don't like that sort of thing. That's completely cool. You can buy your assets at the top. Or you can just have a long-term approach, which Ray Dalio talks about, which is just accumulating good assets when you can afford them and holding them for the long term, and therefore, you know, the ups and downs of the marketplace have less of an effect on your long-term position, which if we look at the long-term average in 92% of the world's index funds in the stock market for the S&P in the last 10 years, even with the third or fourth worst economic event in the last 100 years, which was the GFC, those indexes have still performed at 8.5% per annum. Over that same period of time, you could have doubled your money in most major markets around the world. You could have done it in parts of Australia, you could have done it in parts of the UK, definitely in parts of America, in parts of China, you could have quadrupled it. You know, there's so much opportunity around. It just depends on how you see things. So be safe. If you haven't already done so, please subscribe to the YouTube channel. Check out our podcast, The Pumped on Property Show, which is available on Apple iTunes and Spotify. Like our Facebook page. Check us out on Instagram. Now, if you are thinking about the next couple of years and want to have a chat about it, we are offering free strategy sessions. Jump over to our website, www.pumpedonproperty.com, and book in a free strategy session where myself and my brother will talk about where you are, where you'd like to be long term, what's holding you back, and educate you completely on the marketplace so that you can take that with a grain of salt and go do your own thing, do nothing, or potentially look at working with us at some point down the line when you feel the timing's right for you. So I wish you all the best. Stay safe. Good luck investing. See ya.